All right, now that was a week of volatility. Take a deep breath. Hope everybody's doing okay. We made it to the very end of the week. We can collect our thoughts. We can game plan what the heck happened this week, and we're going to do just that. Welcome back to Stock Market Weekly. I'm your host, Evan Medeiros, for Friday, August 9th, 2024. Let's get into it. I want to change things up. I want to talk about the why. Why did we see so much volatility this week? What was the reason for this week's sell-off? These are questions I actually don't like to spend time thinking about. It's one of the most common questions I get from family, friends, new traders. Why did something move, right? Why did price do that? And it's basically an impossible endeavor to sort of track something down to a single reason, because we're dealing with complex adaptive systems, and it's not the job of a trader, right, to manage risk, to find opportunity. Those are the things we need to focus on. But it was a pretty historic week out there. Let's try to triangulate the why we saw the volatility and the fear that we saw this week. It starts, in my opinion, from last Friday. The jobs report, we talked about it in last week's episode. That put traders on edge. The unemployment tick up, the Somme rule, right? Recessionary fears, the fear that the Fed is in fact too late and the recession is out of the bottle, right? The genie is out of the bottle, and it's going to be tough now to prevent that, right? That was kind of the first thing. We had geopolitical tensions flaring up with Iran and everything happening over there that the market was worried about, retaliations and attacks escalating. We then had on Sunday the Bank of Japan raising interest rates and causing a bit of, what the heck is going on for everybody that was borrowing free money to now have to owe something on that money. That created a bit of a panic and a bit of an unwind on this carry trade, which everyone is, I'm sure, familiar with at this point with all the articles out about it. We saw really, this short vol trade that has been on in size in markets, dispersion trade, some will call it, but basically, suppressing index vol, selling index vol, buying individual instruments. That whole kind of construct blew up this Sunday as well, or Monday. We've got the election outcomes, which are becoming much more nail biting in terms of who's going to win. There's no clarity, and the markets don't like uncertainty when they don't know who's stepping into office. That in itself becomes problematic. We had a little bit of shake of confidence in the AI trade, and to boot, this is all happening during summertime when liquidity is low and there's, people are on vacation, they're enjoying summertime, and this is all sort of stirring underneath the hood there, and just general complacentness in the market, I would say, kind of fueled the events that we saw this week. The events we saw this week with a VIX that spiked to 60, which is historic in its own right. This is now basically a top 3 or so event or week that we saw in the stock market. S&P extending a drawdown to 10%. Nasdaq got down to about 15 or 16%. The Japanese Nikkei falling its second largest drop in history. And after all was said and done, dip buyers came in, they stepped up and bought up this dip. If you were able to survive the Monday and Tuesday session, by the end of the week, we were basically flat in the indexes. Of course, individual stocks are going to fare pretty differently, but by and large, we did recover a lot of that initial fear that we saw future Sunday night into that Monday opening. These are all of the reasons I think the market was ripe for this type of event. And I think, as we go forward now, the fears that we have is to ask the question of, is this over? I think the recession and, how the economy is faring is going to be front and center here for what the market is paying attention to. I also think, of course, you've got geopolitics as well still in play. And then, continues to be company earnings of how companies are profiting in this environment or lack thereof. I would say the positives this week, right? And we're going to get into all the charts here and not just focus on speculation headlines, but the positives here is that the credit markets held in pretty well this week. That was one of the positive sort of canaries there on Monday. We didn't see them blow out. We saw, you know, a little bit of stress out there as you would expect, but it was really an equity event, I think, that we saw this week. And, you know, the economy is still kind of sputtering along, and we know that the Fed is on at least an initial rate cutting cycle, right? These are the positives here that the market can look forward to. So when we start to frame out if this panic is over, these are the big issues, I think, from at least a narrative perspective that we can think about. But of course, we're here to look at charts. That is what we do, is technical analysis, and we try and get very objective looking at the data. So stick around, plenty to talk about in today's episode. Here we go. All right, we are back. Boy, that was a long monologue for me, but it's an important week out there. I wanted to sort of frame out some of the high level narratives. You know, there's probably 20 other reasons why the market sold off like it did or had the volatility that it did this week, but those were sort of the top 8 or so that I could muster up. Now, before we jump into the charts, I do want to bring your attention to my friends over at Investors Business Daily, completely free educational workshop happening tomorrow. This is Saturday, August 10th. It could be today if you're watching this on Saturday. It's at 8:30 a.m. It's free. It's going to be informational. We got some great speakers, picking stocks, managing volatility, how to build a portfolio, all kinds of good stuff. Education, I love it. Sign up with a link in the description of this video. I'll put you on the direct page here so you can sign up. Just drop your email, your name, and off you can go. I believe if you're late, you should get the recording of this if you can't make it in real time, but I definitely encourage you to sign up and see what IBD has to say. Shout out to IBD for sponsoring this show. And now let's get into the charts here. On the week, we can see pretty flat. Hell of a thing, right? If we just look at weekly closes and you never, you know, log into your E-Trade account during the week, then you'd think everything was just kind of kosher here this week. A mild week, down about 0.5% for the Dow, but the S&P, Nasdaq basically flat to slightly up. Russell 2000 down 1%. And the real sort of marvelous thing here is volatility is down this week. Week over week, vol dropped 2 or 3 points here. The VIX down to 20.26 going into the weekend here, down from 23.39. It was intraday or Sunday futures at 60 plus. That is absolutely a huge move. A 60 VIX, for context, is basically implying about a 4% day-to-day move in the S&P index. That's roughly, you know, what we'd be looking at. So thankfully, we saw that unwind here. A 20 VIX is still a bit elevated, but it's certainly a lot better on a relative basis. Let's go to our sectors here. You can see on the week, it was pretty mixed. Industrials led the pack here to the upside, 1.26%, followed by energy and financials. On the downside, it was materials, discretionary, and utilities were down about 1%, but it's a pretty split market. And same thing over the past 1 month of trading. It's been pretty split. Technology is now the hardest hit here, and one of the highlights this week is the fact that the S&P 500 is in fact outperforming the Nasdaq 100 on a year-to-date basis now. So there's been a little bit of a changing of the guard as that rotation trade that we've been talking about is really, you know, continuing to take shape here. If we take a look here at our sector trend, so this is our custom smart trend filter indicator. It's built for TC2000. It's built for TradingView as well. But you can see that we definitely got a little more bumpy turbulence this week. Not for, say, technology, which printed a down bear signal here, sell signal back on July the 18th is when sell signal was produced here in technology, and that stays pretty much the same. But we did see more pressure in financials, communication services this week. We saw discretionary start to roll over, materials start to roll over. So we've got a little bit more kind of sector weakness or some turbulence under the hood, which, hey, is to be expected with a VIX that shoots to 60. I mean, to even see anything that's still standing and mildly positive is pretty remarkable, as we're going to look at some of those charts in just a little bit. But that's kind of the way the sector trends broke down this week. And if we take a look at market breadth, we did see the highest number of 52-week lows made this week. Again, this tracks for the event that we saw on Monday. You can see we had a flare up here of a couple hundred stocks hitting 52-week lows. It did dry up as the week went on, but so did the number of stocks hitting 52-week highs. So we definitely got a little bit of a shock to the system this week. And so now, as the dust settles here, as traders come back, we've got a weekend, we've got some time to digest everything that went on this week. We really want to see how August progresses from here. Can we put in a low? Was that good enough for a low? And can we start to sort of repair the damage, the psyche, the sentiment, right? The resolve in the market here. Can we step in here and start to now look for value in stocks? Can we start to put in some type of bottom here? And can we be encouraged that, the growth fears, the recessionary fears, the Bank of Japan fears of going higher on their interest rate, can we put those behind us? And can we start to stabilize? So I'm going to be paying close attention to breadth underneath the hood. Right now, it's pretty balanced, basically back to a very kind of muted levels for stocks hitting highs or stocks hitting lows. And so again, we're going to want to take a breath here, take a beat, and just see basically how this ratio starts to extend itself heading into the final month of or the final couple of weeks. Really, we're only in the first week of August, so the remainder of the month. Now, if we take a look at commodities here, you can see that natural gas stood out to the upside. So did agriculture and oil, both up 3, 4, all natural gas up 9.5%. So it's certainly constructive there. The dollar index was flat by the end of the week. Gold was down just slightly. Bitcoin, real big roller coaster there, but down just slightly on the week. Copper, silver also falling a little bit. So generally seeing some pressure out here in commodity land. Most of these commodities in downtrends here seen by our smart trend filters. And interest rates, treasury yields, certainly the talk of the town here, particularly on Monday. We saw a plummet of yields across maturities. They did rebound as the week kind of went on, and then Friday they kind of dipped again. But basically, you've got the 10-year now, which accelerated lower and really sort of solidifying this series of lower lows and lower highs, and looks like it was in kind of rollover breakdown mode. And we'll see how this again progresses into the remainder of the month. But for now, yields are falling, and we want to see from a larger perspective, yields are falling on this week. We did get a little bit of a bounce, but we want to see if this lower highs, lower lows trend continues here, as perhaps the market just gets ahead of what the Fed is likely to be doing over the next handful of months. All right, so that's all the data. Let's get into some of the individual stocks this week. Let's kick it off here with the S&P 500. This is a weekly time frame. Take a look at the range here this week. Now, technically, it was a red week. We closed down, but just marginally. I'd call it flat. And this is now the fourth week, I suppose, down in a row for the S&P 500, even though it was relatively flat. But as we talked about at the top of the show, our drawdown monitor gets us to just shy of 10% here for the S&P 500. So this is now officially the largest pullback that we've seen year to date, eclipsing the April to May pullback that we saw. And if we go down to a daily chart here, we can see what the action looks like. This was Monday's open right here, this panic open. The S&P 500, of course, is a little more muted. When you start to look at some individual stocks on Monday, you really did see some gnarly prints in some of those names. Some stocks that you never thought they would get back to fill some old gaps from months or even a year plus ago, and they did. So we saw some interesting opens here on Monday. It was very tough to get fills. I was certainly fighting for fills on Monday open, and I basically whiffed on nearly everything I was trying to dip by. But here it is, Monday's action. We did get a wick down to basically 51.19 in the S&P 500. And you can see after a very volatile session, we closed off the lows, but pretty much at the middle of the range. Tuesday was, again, another kind of mixed day where we saw a good amount of volatility in range, but we still closed towards the mid to low end of things. Wednesday gave some concern here for the market where we, opened high and then basically sold off and made it look. Wednesday gave us that look like, uh-oh, this is not over and we might need to come back down and retest the lows. But anyone that was in that camp that was looking for a short signal back to the lows or was just reducing exposure into Wednesday got caught flat-footed, because Thursday we turned things around and then followed through on Friday. So in hindsight, of course, it all looks so easy to navigate, but that was the story. Lots of emotions, VIX to 60, lots of fear out there. What's happening with the Bank of Japan? What's happening with this economy? Is the Fed too late? All of those headlines were circling this week as traders were trying to navigate the actual price action here. And this is why we try and game plan ahead of time in these situations, right? So for the last couple of weeks, perhaps too complacently, we have been talking about this, this pullback that has been in motion here and sort of game planning where this market could go, where we would want to come back in and maybe find some dip buying value and opportunities. And here it is, front and center. But of course, it's not going to be easy in the moment, because it's going to come with a lot of fear and uncertainty. And we sure did get that this week. So if we go back here to the S&P 500 and we think about where we've come from and where we can go now, if we throw on Bollinger Bands here for the SPY, this whole chart template I need to update. You can see on Monday just how extreme this move was, though. This was one of the largest drops we saw in the S&P 500 in a couple of years, and it was entirely below the lower 2 and 20 Bollinger Band. Take a look at the volume that traded on Monday as well. This is definitely a standout here. So I've got actually dollar volume on this chart. So we had $75 billion of SPY volume traded on Monday's trading session. That's the highest going all the way back to 2022 when we were, seeing some panic down here in that January timeframe. So this was a pretty aggressive day here in terms of trading, turnover, flows, and funds taking action on this day. And then of course, volume sort of tapered off here into the end of the week. We did get back into the Bollinger Band here, but if we take a look at what's been happening here now from a more sort of price trend structure, you can see that we still definitely have a series of lower lows and lower highs in place here over the past month of trading. And the question now is, are we setting up another bear flag similar to what we saw 2 weeks ago? And this is something I think that we are really going to be wanting to pay attention to on Monday, of the mood of the market, like we talked about just moments ago, after we've had time to, take a break and decompress a little bit this weekend. How do traders come back into this market and think about things and think about the opportunities and risks going into the end of this month? Are we going to be able to sustain here? Can we break this bear flag and just kind of move sideways, or continue to grind up and fill some of these old gaps? Or do we need another test of these lows? Now, sort of said another way, are you confident that this was a deep enough, sharp enough washout that we can truly V-shape recover from these levels without coming back in and testing 5,100, without going sideways here? Can we, just V-shaped higher like we saw even last year, November, fourth quarter of 2023, where we kind of like sold off to the 4,100 and then just V-shaped out of it like we did in 2018 and a handful of other times? Or is this going to be a more controlled sort of digestion where we get some two-way trading, maybe another retest down here, put in, a little bit of a base, a range, an accumulation period, and then we start to lift back up, right? That's what we're kind of looking for. If this bear flag does end up triggering and we are not done in this correction, then you're very quickly looking at the April lows here, which would be around 49.58, just to keep an open mind here. If we leg down again and we're, say, 3/4 of the way through this correction, then we would have in total, if we got all the way back down to the April lows here, we would have about a 12.5% correction in the S&P 500, which, look, let's be serious, in the grand scheme of things, isn't that outrageous, isn't that deep of a correction, okay? Not saying it has to happen or it's going to happen, but that is just game planning sort of a bear case scenario where we end up breaking down from here. Either recessionary economic data continues to worsen, geopolitical, all those things, right down the laundry list. Pick the one that ends up really sort of being the kindle to the fire to set off the next leg down. So that's the open-minded concept here. I think with a 60 plus VIX and the type of volume we saw traded, it feels pretty capitulatory to me, but I still would not be surprised to see at least another retest of this area. Maybe we only put in a higher low. Maybe we get down to 51.70 or so and then find buyers, put in a higher low, and then start a march up. That makes a lot of sense to me. But for now, I think we just need to see some more evidence here. We've had a nice bounce off the lows, right? So let's not forget about it. In the short term, we're up about 4.5% from the lows here in the S&P 500 on Monday. So again, I think this is the spot where things just get a little more dicey. Dip buyers that maybe took some courageous buys in here on Monday are maybe, lightening up a little bit in this area and taking some profits off the table, and going to just kind of wait and see. If we look at the Nasdaq 100, I mean, we kind of have the same situation. We just have the numbers that are a little bit bigger. Now, of course, the Nasdaq 100 has corrected now, certainly deeper, and now is underperforming on a relative basis. So the Nasdaq's got a 15.71% correction here. It did manage to fill this gap all the way back here from the beginning of May. And again, dip buyers stepped in and were rewarded here with about a 6% rally off of the lows or the open on Monday, if you could get those fills. So we've had, again, a nice push up here. We've got an open gap from last Friday, August 2nd, that the market could fill in here. If we take a look at volume traded, again, it was a pretty impressive number. It actually wasn't as high in the dollar volume, wasn't as high in the QQQ. You can see it goes back to basically 2023 levels. So again, TBD. Right now, we do still have a series of lower lows and lower highs in the very short term, but you're certainly getting some more bargain prices relative to when this market was in an unstoppable uptrend in May, June, and July, right? So we've got the pullback. We've got some better, perhaps prices in some of these individual stocks. It's now going to come to time frame and, being more of a stock picker, I think, in this type of environment. Same comments apply, though. Are we setting up for another bear flag here? And how does this end up resolving? Are we coming back down to the April lows around 413 before all is said and done? So Q's kind of looking like that. And Russell 2000, I mean, honestly, this is now back to the same old range here. This clearly, had this, at this point now, a big breakout kind of failure up here, where we launched out of this multi-year resistance area. We traded sideways for a couple of weeks, and then we got hit with this bomb to kind of sink us back into this range. I mean, generally speaking, I mean, it held up there, semi-reasonably okay. I mean, it's a 13% drawdown, so call it somewhere in between the S&P 500 and the Nasdaq 100. It actually didn't correct as deep as the Nasdaq 100 has done since its highs here a few weeks ago. So there's something to be said about Russell 2000 outperformance, or some relative strength. It's not just totally rolling over and going back to the graveyard here. So Russell 2000, I think the level is pretty clear. Back over 210 210, things can get exciting again. But until and if we can muster up the strength to kind of break back out, fill this gap, get back above this old resistance, that's what we're kind of waiting for. I do think the Russell 2000 in some respects is the easiest to kind of discern and figure out from an index trade perspective, because you do have a very clear kind of line in the sand here up around 210. All right, so that's the way I'm kind of looking at all of this. Of course, the VIX, like we've been talking about here, spiking all the way north of 60. It's down to about 20. It's dropping in a straight line here. And so once again, let's pay attention to this. Let's see how volatility acts over the coming weeks. And see what kind of flare up we get. I'd be surprised if we continue to just sink right back down to sub 15. But if we do, then I guess that means the bull market and easy trend to the upside is back on the table. So we'll see how that shakes out next week. I talked about high yield credit, and this was one of the positives I think this market we saw earlier in the week. If we take a look at LQD, or you could look at HYG, there's a handful. But if you're looking at kind of high yield corporate bonds, I mean, this structure here really stayed in place, right? Nothing got blown out. There was obviously some stress and panic on Monday with this candle down here. So we saw yields, stressing out, but we didn't see anything like we saw back here in 2020 COVID times, for instance, or a real crisis. We saw, kind of a mini knee-jerk reaction lower. And I think this is some comfort here for the market, is the credit markets really aren't saying that there's anything too extreme happening right now or big concerns out there in the market. So that's kind of the big readout there. Lots to chew on, lots to think about going into this week. I mean, basically, of course, the way I approach it, I have 80-90% of my funds in just my automated trading systems, which are all going to take their specific rules. For me personally, I started to do some buying on Friday, which I think I mentioned last video. So on Friday, I started to go into some longer term ideas that I was finally starting to see some value in. And on Monday, I added to those ideas. So I really kind of came into the market I started buying some things on Friday, added to those things on Monday. I wish I could get some of the opening prices, which I could not get, but filled throughout the day on Monday. And then on later in the week, I forget when, Wednesday and Thursday, I lightened up a little bit, or I sold some covered calls, or I'm just managing these positions, right? I don't know if we're done in this correction, but I want to be able to accumulate stocks that I like. I'm not accumulating the SPY. I'm looking at other names, but I'm going to be trading around them, and I'm going to be kind of trying to keep things still kind of light and delicate here and be looking to accumulate more as prices come down. That's my style. That works for me, and I'm controlling position size. But again, like we talked about last week, if you're a swing trader that wants the coast to be clear, we're not in it right now, right? We don't have a coast is clear environment. We've got a bounce in a lower lows, lower highs, 1 month intermediate term downtrend. So right now we're coming into resistance here in the, medium term, however you want to draw it. And now we need to wait and see if the market can break this pattern to the upside, or if we're going to roll back over or chop around for some time. All right. So you got to kind of understand, who you are as a trader and what your trading strategy is and time frame and all that good stuff. So tricky week out there, lots to think about. Hopefully everybody managed through it okay. Hopefully this video was helpful for you. Don't forget, IBD webinar in the description of this video. Check it out. Go learn something. Take a little bit of time off of staring at charts and go learn from some pro traders in that webinar. I've also got links to our trading systems and all the cool stuff we have for TC2000 in the description of this video as well. Thanks as always for tuning in. We'll see you back here next Friday. Take care. Have a great weekend, and we'll talk to you in the next video.